Welcome to Module 2, Understanding the Greeks, Key to Managing Risk. The Greeks are essential tools for options traders, providing insight into how different factors influence an options price. By understanding the Greeks, you can assess risk, optimize your trades, and make more confident decisions. Let's break them down in simple terms. Delta, directional risk. Delta measures how much an option's price changes when the underlying stock moves by $1. For example, if a call option has a delta of 50 cents, its price will increase by 50 cents for every $1 rise in the stock price. For put options, delta is negative, meaning the option gains value as the stock price falls. Example, a put option with a delta of negative 50 cents will gain 50 cents in value for every $1 drop in the stock price. Delta also gives insight into probability. An option with a delta of $0, 30 has roughly a 30% chance of expiring in the money. Gamma, the acceleration of delta. Gamma measures how much delta changes for every $1 move in the stock price. If a call option has a delta of 50 cents and a gamma of 10 cents, a $1 move in the stock price will increase delta to 60 cents. Gamma is highest for at-the-money options and decreases for deep-in-the-money or out-of-the-money options. Why gamma matters? It helps you predict delta movement, which is key for managing options near expiration. High gamma means your position is more sensitive to price movements, requiring closer monitoring. Theta, the effect of time decay. Theta measures how much value an option loses daily as it approaches expiration. Since options are wasting assets, they lose value over time, especially if the stock price doesn't move favorably. For example, an option with theta of negative 5 cents will lose 5 cents in value every day, all else being equal. Why theta matters? For buyers, time decay works against you. If the stock doesn't move, you lose money. For sellers, theta works in your favor. Option sellers profit as time decay erodes the option's value. Vega, sensitivity to volatility. Vega measures how much an option's price changes for every 1% change in implied volatility. For example, if an option has a Vega of 10 cents, the option price will increase by 10 cents for every 1% rise in implied volatility. Why Vega matters? High IV environment. Options are more expensive. Watch out for IV crush. Low IV environment. Options are cheaper, offering better value for buyers. Before major news events like earnings, implied volatility spikes. If you buy an option before earnings, you could still lose money even if the stock moves in your favor, because IV crush lowers the option price after the event. Rho, interest rate sensitivity. Rho measures how an option's price changes with a 1% change in interest rates. For example, an option with Rho of 5 cents will increase by 5 cents if interest rates rise by 1%. Rho primarily affects long-term options like leaps and is less important for short-term traders. How to use the Greeks to trade confidently. Delta for direction. Predict how much your option price moves with the stock. Gamma for sensitivity. Monitor gamma for at-the-money options. Theta for timing. Be mindful of time decay. Vega for volatility. Consider IV before entering trades. And Rho for long-term strategies. Factor in Rho for leaps. By understanding the Greeks, you'll manage risk more effectively and trade with greater confidence. Closing and what's next. Great work. You now understand how the Greeks impact your trades. In Module 3, we'll explore implied volatility and IV crush, one of the most important yet overlooked aspects of options trading. See you in the next module.